Moffat and I'm part of the Entrepreneurial tax team here at Chiene Tait. Today I'm going to be doing a session on the Enterprise Investment Scheme and the Seed Enterprise Investment Scheme, also known as EIS and SEIS. Within the session today I'm going to be giving a bit of background about the schemes, the associated tax reliefs, and the types of companies and investors who will qualify under the schemes. The Seed Enterprise Investment Scheme and Enterprise Investment Scheme are HMRC approved and government legislated tax relief schemes which provide tax benefits to individuals investing into a qualifying high growth company. These schemes were introduced to try to help alleviate the problem faced by these types of companies when raising equity finance by mitigating some of the risk of investing through providing generous tax reliefs to the investor. There is no tax impact for the company receiving the investment through these schemes. SEIS is aimed at earlier stage companies and, as you will see, the tax reliefs are higher under this scheme to mitigate the associated increase in risk for the investor. The rules surrounding SEIS and EIS are very intricate and have lots of exceptions and nuances, so today I'm only going to be covering the basic rules. We would always advise that you take advice in relation to your own company or investment. Chiene Tait have advised hundreds of companies on EIS, and we also work with some of the largest angel investment syndicates advising on complex EIS issues. So which companies will qualify under these schemes? To qualify, the company must be an unquoted trading company with a permanent establishment in the UK. The company must also be undertaking a qualifying trade. There are a list of excluded trades within the relevant legislation, which, to name just a few, include leasing, property development and farming. The company must be independent, i.e. not under the control of another company, and any subsidiaries must be qualifying subsidiaries. There are also rules around the age of the company. For EIS, the company must be within 7 years from the date of their first commercial sale. For SEIS, qualifying trade must not have been carried on by the company or any other person for longer than 2 years at the date of share issue. There are also limits on the size of companies that will qualify under these schemes. As you can see in this table, there are limits on the gross assets and number of employees that the company can have in order to qualify. You can see here that SEIS is aimed at smaller, earlier stage companies than EIS. EIS limits are also extended if the company is knowledge intensive. I won't be covering the conditions for knowledge intensive status. Broadly, this covers companies undertaking research and development. The investment limits are reduced by any grant funding received by the company. For SEIS, the £150,000 limit is reduced for any de minimis grants received. The EIS limits will be reduced by any notified state aid grants received by the company. The SEIS and EIS schemes work together, so if you're looking to raise £300,000, you could split this and raise £150,000 under SEIS and £150,000 under EIS, but you would need to do this over 2 separate days, with the SEIS investment first on day 1 and the EIS investment on day 2. There are also some more general qualifying conditions on the investment, which I'll cover briefly. The shares being issued must be ordinary shares, which throughout the 3-year period following the investment do not hold any preferential rights. There cannot be any pre-arranged exits. The money raised must be employed for the purpose of the company's qualifying business activity. There is also a risk to capital condition which was introduced by the Finance Act in 2018. This was brought in to ensure that tax reliefs are not available for investments that are not within the spirit of the scheme. This condition is made up of 2 parts. The first is that the company must have objectives to grow and develop over the long term. The second is that the investment must carry significant risk that the investor will lose more capital than they will gain as a return, and this includes any tax relief. So who can invest under these schemes? The investor cannot be connected to the company in the 2 years prior to their investment until the termination date of their shares, which is generally 3 years after their issue. The investor cannot hold or be entitled to hold more than 30% of the ordinary share capital or the voting power of the company. Employees are connected to the company and therefore cannot invest under either scheme. Directors, however, are slightly more complex. For SEIS, Directors are not deemed to be connected to the company and can invest under SEIS. For EIS, however, the general rule is that directors are connected. There are exceptions to this rule. These exceptions are quite complex, and I won't be covering these within this presentation. When considering whether the investor is connected to the company, we also need to take account of their associates. The investor must not have an existing shareholding in the company. If the investor holds any existing shares, these must have been acquired through a previous SEIS or EIS investment. The investor cannot have any linked loans, and the investor will not be eligible for relief unless the investment is made for genuine commercial reasons. In looking at the tax reliefs that are available to the investors, you can see that SEIS has a higher rate of tax relief at 50% versus the 30% available under EIS. Again, this is because SEIS is aimed at those earlier, higher risk companies, and therefore the tax reliefs are higher to mitigate this. Investors can only invest up to £100,000 per year under SEIS. Under EIS, this is £1 million, but is increased to £2 million if the additional £1 million is invested into knowledge-intensive companies. Under SEIS, you get a 50% reinvestment relief for capital gains tax. This means that where an individual disposes of an asset that would give rise to a chargeable gain and reinvests all or part of that gain into SEIS shares, half of the amount reinvested will be exempt from CGT. Under EIS, you do not get reinvestment relief, but you do get a deferral relief, which is essentially a timing benefit. If the investor disposes of an asset that would give rise to a chargeable gain and reinvests the gain into EIS qualifying shares, they do not need to pay the capital gains tax arising on that gain until they dispose of their qualifying shares. The reinvestment must be made within 12 months before or 36 months after the disposal of the asset. The investor must have UK tax liabilities to set the tax reliefs against. The shares must be held for a period of at least 3 years from the date of share issue for the reliefs to be retained. If the shares are disposed of within that 3-year period, if the company ceases to meet the qualifying conditions within that 3-year period, then some or all of the tax reliefs will be withdrawn. If the shares are held for the entire 3-year period, then any gain made on the sale of the shares will be exempt from CGT. To demonstrate the tax reliefs available under SEIS and EIS, I've included some worked examples based on an investment of £100,000. These examples also demonstrate the loss relief available to investors if the company fails. We've assumed in this example that the individual is a Scottish taxpayer paying the top rate of income tax. So, what is the general process of obtaining tax relief under one of these schemes on an investment? The first step for investments is generally to obtain an advance assurance, and often investors will insist on a company obtaining an advance assurance as a condition of their investment. The advance assurance is a non-statutory service where HMRC will offer an opinion as to whether the proposed investment will be a qualifying investment for the purpose of SEIS or EIS. HMRC no longer accepts speculative applications, so you now need to include details of the proposed investors or fund manager within your application. Once you've received advance assurance and you've taken your investment, you can then complete a compliance statement known as an EIS-1. This can only be submitted once you've carried on the qualifying business activity or research and development for 4 months, or if your investment is SEIS qualifying, once you've spent at least 70% of the amount raised if this is before that 4-month period. Once HMRC have processed the compliance statement, and if they agree that the investment meets the legislative requirements, then they will issue a compliance certificate for the company, known as an EIS-2, and EIS-3s, which will need to be completed and passed to the investors, which they will then use to claim their tax reliefs. As I mentioned earlier, it's important to ensure that your company continues to meet the qualifying requirements for the 3-year holding period, to make sure that your investors will get their CGT relief when they sell their shares and keep all of their tax reliefs. If the qualifying conditions fail to be met at any point, then all or some of the tax relief can be clawed back.